I just show the scale of all of the bubbles that are out there, and that we have been in the bubble century and people think it's normal. The markets and real estate have a lot further to go to crash, not a little. People that say, well, they'll go down another 20% or 50%. No, it's going to be a lot worse than that. Hi, everyone. I'm Mike Maloney from goldsilver.com, and I just released a book, The Great Gold and Silver Rush of the 21st Century. I want to thank Adam for putting on yet another great seminar. And I've got a presentation for you that I think you're really going to enjoy. I think, I'm going to show a little bit of the banking structure, the bank crisis, then how the banks are structured so that you understand a little bit more about this banking crisis and why it's happening. I'm going to give you a little preview of my book, and I'm sort of going to close by showing you that, yes, we sort of have passed the point of no return. Our politicians can no longer borrow their way to prosperity. We're at a point where there's going to be major changes in the future. We're not going to just recover out of this recession that is coming and then go on like it was after 2008. And we had this big debt-based party. And then I'm going to make an airtight case for gold and silver I think you're going to enjoy. So, Dan, if you can put my screen up for me. These are the unrealized gains or losses on investment securities at the banks. And this is all of the FDIC banks in total. Now, I did a little research, and it said that there was 4,200 FDIC insured banking institutions. But of those 4,200 last year, 4,800 of them reported. And so there's about 4,800, a little less than 5,000. But if you take a look at this, this was the crisis of 2008. But with Powell's rate increases, it has caused losses. All banks hold in their portfolio a certain amount of bonds, and the securities that they're talking about here are U.S. Treasuries and mortgage-backed securities. Not all of them hold mortgage-backed securities. Pretty much every bank holds some sort of U.S. Treasuries. But these are the losses there. So instead of $75 billion, it's $675 billion. So I'm going to move on to the next thing here. This was a report that a bunch of PhD economists did after it was done after the Silicon Valley Bank failure and when everything hit in the news. So they did that over the weekend. They came out with it in the 15th. The 13th. So it's basically analyzing something after the fact. And you really want to start following people that anticipate what is going to happen in the future. And the only way that I've found to do that is to look at the fundamental structure, the numbers, to stare at balance sheets and charts on the Federal Reserve's banking, on their educational system, the Fed, and try to figure out how things work and what instabilities are in the system. But anyway, they say that the banking system's market value of assets is $2 trillion, lower than suggested by their book. So this is all of the banks in aggregate. Mark to market, the assets have declined by an average of 10% across all of the banks, with the bottom 5th percentile, which is the bottom 20%, experiencing a decline of 20%. 10% of the banks, which is a little bit, I put this in here, that's a little bit less than 500 banks, have larger unrecognized losses than those at Silicon Valley Bank. So their U.S. Treasuries and possibly mortgage-backed securities are underwater even further than at SVB. With 10% of banks, that's again a little less than 500, having lower capitalization to back them up than SVB. So these banks are in worse condition that way. On the other hand, SVB had a disproportional share of uninsured funding. That means they weren't hedged for this interest rate risk, where Most banks are. Only 1% of banks, but that is still 50 banks. And those 50 banks are most likely inside these 500 that have worse balance sheets than SVB. So we potentially, I'm not saying this is going to happen, but there is potentially this wave of bank failures coming. So let's take a look at the financial crisis of 2008 and how that played out. April 2007, New Century Financial went bankrupt. September 2007, there were bank runs at England's Northern Rock. Then in March of 2008, Bear Stearns collapsed. This was the inflection point. So the other two were just considered these accidents that happened that were annoyances. They weren't, at the time, we didn't consider them canaries in the coal mine. Now, with Bear Stearns, we can see that these were little precursor events leading up to something, and there was something genuinely wrong in the whole financial sector. And then in July, IndyMac and Countrywide Financial collapsed, and there were actually bank runs at Countrywide, which is in the West where I was, and that really started the ball rolling. So you have here 5 months, 6 months, and 3 or 4 months, and then the next month, I'm putting the day in here now because this is going to speed up. Fannie Mae and Freddie Mac were nationalized, and it was because of this Countrywide IndyMac collapse. They had to nationalize Fannie Mae and Freddie Mac. September 15th, so you're only talking about 1 week later, Lehman Brothers, largest bankruptcy in history. The next day, AIG gets bailed out. A little over a week later, Washington Mutual collapses. A month later, now it slows down a little, but look at how these things just keep on coming month after month. October, Fed unveils its Troubled Asset Relief Program and commits $700 billion in taxpayer funds. Now, this is a private corporation committing taxpayer funds somehow to the banks. This always just cracks me up. I'm sorry. November, the next month, Citigroup gets bailed out. December, General Motors and Chrysler get bailouts of $80.7 billion. The next month, Bank of America gets bailed out for $20 billion. The next month, President Obama approves a $787 billion stimulus. Then we get a little bit of a break before General Motors, who had just gotten bailed out, files for bankruptcy and closes 14 factories, laying off thousands of workers, which were a small contributing factor to October's 10% unemployment report. And to end the year, there was a record of 2.9 million real estate foreclosures that year. Nothing close had ever happened before. Now, why is all of this happening? Let's take a look. It's basically because we're inside of this really evil monetary system, and you have to really dissect it and understand what's going on to be able to see why it's evil. But it's sort of like everybody is in the matrix, and the only way to take the red pill and get out of the matrix and be able to see the matrix from the outside is to dig way deep into things like the Federal Reserve Act. So here is their Section 14 on open market operations. This is a page from my book, and it says, hint, if you want to know the true meaning, read only the red words. To buy and sell bonds and notes of the United States issued in anticipation of collection of taxes. This is the biggie. This is what underpins what backs our currency. The whole currency system is backed by the extraction of work hours out of you, the public, in the future. So they're issued in anticipation of collection of taxes or other obligations, which are direct obligations of the United States or which are fully guaranteed by the United States as to the principal and interest. So that's what the Federal Reserve buys to back the currency. But what if the United States is guaranteeing it? I mean, how does the United States guarantee it? They guarantee it by extracting taxes out of you. So it isn't the United States guaranteeing it. It's you guaranteeing the dollars in your pocket. And then those bonds. Now, there's a big opportunity right now in bonds. Eventually, the Fed will pivot, and bonds will go way up, and there will be a big payoff. And a U.S. Treasury is the safest bond that there is, because the reason it's safe, it's different. Corporate bond, corporation says, loan me some cash right now, and I promise that I'm going to create goods and services that are going to help the economy. People are going to want to buy this, and with the profits, I'm going to pay you back in the future. When the Treasury issues a bond, they're saying this is the safest investment that you can make. We are absolutely going to pay you back, because if you loan us some currency now, we're going to hold a gun to somebody's head in the future and extract taxes out of them. They may not hold a gun, but they still threaten you with jail time. And remember that the root word of bond is the root word of bondage. And this is a market that I can't participate in. Simply, maybe my moral compass is turned up too high. But I think everybody should know what they're doing when they do it. And when you buy a U.S. Treasury, any sovereign debt, you are buying the enslavement. You're participating in a market. You're making a market for the enslavement of a population, because the payoff out of it has to come from your future work hours, your children's future work hours, and your grandchildren's future work hours. That's what supports our national debt. That's what supports that's what backs the currency. So in your bank account, the Bank of England says this, are reminder digits that remind the bank that it owes you a certain number of IOUs. And the IOUs that it owes you are central bank IOUs, the paper notes. And so what backs those paper notes? What are those Treasury bills, notes, and bonds? They're an IOU, which promises to pay the bearer of the IOU your future taxes. The entire world monetary system can be summed up in just 6 letters: IOU, YOU. So IOU, you. The whole system is totally insane. Investigate it for yourself. Dig as deep as you can. Buy my book, The Great Gold and Silver Rush of the 21st Century. There's only about the last third of it that is about gold and silver. Everything else is about what's wrong with the economy. The study of currency is what John Kenneth Galbraith meant. But the study of money, he says, above all other fields of economics, is one in which complexity is used to disguise truth or to evade truth, not to reveal it. This is absolutely true. But you can dig deep, buy my book, and verify all of these things for yourself. It's got a whole bunch of endnotes. It was researched for years and years by it was me and a team. I had people working with me. This is out of the end of chapter 4, showing that the stock markets were on life support for the entire time since 2008. And the stock markets fool the economy into thinking, well, the economy's back. But this was all financial engineering. No goods and services created, no true wealth. And so what you have here is the monetary base. So that's base currency, paper dollars in your wallet, and bank reserves. Interest paid on reserves. When they did QE, all these massive quantities of reserves got stuck in the bank's reserve accounts. And Ben Bernanke decided we had to pay interest on them. And then Treasury bill purchases during the repurchase agreement crisis in late 2019. And what you see here is these things line up perfectly. And then the correlations. Now, this is Microsoft Excel making these correlations. 0.989, 0.974. Now, remember that a correlation of 1 means they're exactly the same. Correlation of 0, no discernible relationship. Correlation of -1 means they're the opposite. So 0.989 means it's 98.9% the same. This is QE 1, 2, and 3 at 97.4% the same. In other words, when they created 10% more base currency, the stock market rose by 10%. If they created 20% more base currency, the stock market rose by 20%. 0.944, 0.976. The lowest is 0.929 because during the COVID crash, they pumped a bunch of currency into the system, and for a little while they went opposite directions. But if you start your measurement after that, where things were going opposite directions, it's 0.961. So they say that correlation is not necessarily causation. But I want to say that conflation of correlation with causation is worth consideration. This is, sorry, I've got to do something here. This is the Fed funds rate is the blue, and the gross federal debt as a percentage of GDP is in red. And what we see here is Chairman Powell trying to raise rates at the fastest pace in history. Nothing like this had ever happened. He thinks he's going to be able to get tough on inflation and be a Paul Volcker. Well, look at where the federal debt to GDP had dropped to. It was 31 to 33% when Powell decided to slam interest rates. And on a daily, this goes up to like 22%. Not Powell, Paul Volcker. And now Powell is absolutely trapped. One of the reasons that he's trapped at these, when there wasn't that much debt, it was easy to raise interest rates without causing the payments that we make on the national debt to basically break the bank, break the Treasury. Here is the interest on the national debt, the size of the yearly payments, and it was $600 billion before Powell started raising this, and now it's $850 billion. So he added $250 billion by raising rates. The amount that the U.S. government has to pay out of our taxes went up by $250 billion. But let's zoom in on that a little bit. And what you'll see is that data, this is quarterly data, and we have yet to even get the final, this is quarterly as of the end of their fiscal year, September 30, but we don't have data to the end of 2022. Yet the rate then was at 3%. So we've piled on every day. They roll over treasuries that are coming due. There's about 2 auctions every single day. So this thing is going exponential right now. They are absolutely trapped. He's going to have to pivot. Something, I've been saying for about 8 months that something will break. And then I will say it looks like that Powell is just going to continue raising until something does break. And I've been saying that for about 6 months. Check out some of my old YouTube videos, especially the last 3 of 2022. That's a series that started, it's part of a warning to the Fed. This is the stock market versus current government tax receipts. In my book update in 2015, I came up with something called the Financialization of Government, the dangerous fog. And most people don't see this stuff. And so anyway, this is the crash of 1987. If I zoomed up on that, you'd see that this is huge. There was no relationship with the revenues that the government gets from taxes. In fact, taxes rose the year after that crash. But since the financialization of government, whenever the stock market crashes now, this is the crash of 2000, tax revenues go right along for the ride. And then this is the crisis of 08. Then there's this disconnect here where the wealth in the stock market is running way ahead of the tax revenues. But the problem is our politicians, when they decide to create a budget, they extrapolate the growth in those tax revenues infinitely out into the future. They have never plugged in, well, what happens if tax revenues fall? That has never happened. So the next chart is basically the same chart, but I've added the budget deficit / surplus. This surplus wasn't real. If you look at the change in national debt, it wasn't real. It's creative accounting. But as soon as the stock market crashed and tax revenues fell, the deficit exploded. Same thing in 2008, it exploded. The COVID crash and the contraction of GDP causes this to be skewed a little bit differently. But The next time, we've already planned, the politicians are planning on spending $1.4 trillion more than their income. That's the budget deficit. The actual surplus or deficit, fiscal deficit, will be much, much worse than that at the end of the year. So the Federal Reserve is about to launch an instant payment service called FedNow in July, and this is the gateway to their central bank digital currency, which I believe is just an evil beyond all evil. Get my book, Great Gold and Silver Rush of the 21st Century. A lot of what you have seen is in my chapter 4, which is free online. Just go to GGSR, Great Gold and Silver Rush 21.com, GGSR21.com. Read it there or download it as a PDF. Send it to anybody you want. It's free, chapters 3 and 4. Quick, a couple of charts from chapter 5, which is in the book, not online for free. I just show the scale of all of the bubbles that are out there, and that we have been in the bubble century and people think it's normal. The markets and real estate have a lot further to go to crash, not a little. People that say, well, they'll go down another 20% or 50%. No, it's going to be a lot worse than that. This is how many work hours to buy the S&P. This goes all the way back to 1860. And you can see, yes, we were in the bubble century and you've gotten used to it. This is the Buffett indicator. A lot of people look at this. This was made yesterday on the Fed's website. But a lot of people look at this and say, well, the up tilt over time is because the markets are getting more efficient. Baloney. I have data that goes back further. This is also from the Fed's data. And this goes back to, I think, 47. And I want you to notice the 3-bubble peak in this century, and then the dip in 1980 and the bump in the 70s and 60s, because you'll see it in other charts. Now, this is the data that most people have access to. This is as far back as anybody has been able to create a Buffett indicator. But I had my researchers, one of them we just had to go really deep to find data going back further than this. This is 74 years. We can get a better perspective if we add another 70. If we add another 70 years to it, sorry about that. This is 2 European economists that did a study on 17 advanced economies going back to 1870. And yes, we are in the bubble century. The market, this is going to change. It's going to come back down to reality. So strap in for this, because this is going to be the coming recession that we're going into and the banking crises are going to lead to a loss of confidence in the financial system, in all of these overpriced investments. But one of the things to worry about, zombie companies are companies that can't afford to pay the interest on the debt that they owe, not just the principal, but the interest out of current cash flow. Before 2000, it was about 3.5%, and then it exploded with the contraction of GDP after the crash of 2000. That's what causes this to go up. And then the economy gets better, companies start making profits again, and then the crisis of 2008 caused this to explode. But then 0% interest encouraged all of these companies during this time when they should have recovered to just walk a really dangerous line to where now 20%, this is 1 in every 5 companies that could be going bankrupt in this next crisis. Can you imagine driving down a downtown street in your area and 1 out of every 5 stores is boarded up? I'm not saying that's what it's going to look like, but that's the picture I have in my mind when I see this chart. Are we past the point of no return? I asked my researchers if for every dollar we borrow, how much do we get back? And for every dollar we borrowed after World War II, we used to get between $6 and $8 worth of growth. But that has declined as we built up debt and we owe so much interest. Since 2008, it's averaged a 50% contraction. We borrow $1, we get 50 cents worth of growth, but we're $1 deeper in debt. this is a formula for bankruptcy. Have we passed the point of no return? Absolutely. Now, the 70s bull market in precious metals was the biggest bull market in history to that date. Cryptocurrencies have outshined that since, but not by a whole, I mean, yes, by a whole lot. But before that was a brand new asset class. It's the first new asset class, I believe, since the year 900 when bonds started being traded. And so, yes, when you're starting at zero, from 0 to 1 is an infinite return. And so that has been the biggest bull market in history. But before that, it was gold and silver in the 70s. And in just 8.5 years, gold went up 25 times its original price, silver 41 times. This is real estate here, and this is the stock market here. And what I did was I started all of these not at a specific date, but at their very lowest price of that decade to give them the maximum advantage. And then I ended them all the day that gold and silver peaked in January of 1980. So gold has been the best investment of this century as far as something that is a total asset class that is solid, and you can hold it in your hand. It has no counterparty risk, and it can't go bankrupt. So here it is compared to the S&P 500. So anybody that invests in gold is wearing a tinfoil hat. Well, break out the tinfoil. I want to make as many hats as possible. This is today versus 1980. So from 1980 to today, there are 18 times more people around the world that can buy gold and silver. In the USSR, the Warsaw Pact Eastern Bloc countries, China under Mao, it was illegal to buy gold and to own gold, and there were no exchanges. The people that drove the price up 25 times on gold, 41 times on silver, are the people that had access to buy gold where it was coming off of an exchange, because the exchange sets the worldwide spot price. In the first half, in the first half of the 70s, it was just Western Europe and Canada. Then in 75, it became legal to own gold in the United States. 76, Australia. And so by 1980, 10% of the world's population could participate. And today, we've got billionaires in Africa, in India, South America, everywhere around the world. There are now billionaires, and everybody except for North Korea can participate in this market. It is 18 times the size of the population. They have 50, according to the Organization for Economic Development and Cooperation, the OECD, there is 55 times more currency on the planet that can come chasing gold and silver. There's 56 times more millionaires, 200 times more billionaires, 220 times more available consumer credit, 31.5 times more assets under management, 49 times greater stock market capitalization. There's only 2 times more gold. And so when you take a lot of these, like these millionaires are part of the people that have 55 times more currency, and so are the billionaires, and they're both part of the people that have assets under management and stocks. And so to eliminate double counting, I just took this and rounded it down to 50 and said, if 50, there's 25 times more units of currency per ounce of gold that could come chasing gold and silver this time around. So this is going to be huge. So go to ggsr21.com and get my book and look at those free chapters first if you want. So this is a roadmap to both protection and, I believe, profit. Now, I am the only way to get what I offer here. I have an insiders program where I tell all of my customers. So you have to actually go to goldsilver.com, create an account, and if you buy from us, then one of the things you get is this insiders program if you make a qualifying purchase. And the insiders program is I come out with videos once in a while. If I make any move in my personal investments, I let you know what it is and why I did it. I don't give any advice ever. I just tell people what I see and what things are. And I've done very well on my precious metals purchases. And I have 23 different indicators that I'm evaluating right now as to looking for when to sell. That's the important thing. You do not want to allow emotion to guide your investment decisions. It's got to be based on numbers. And by back testing these indicators, I've already found a few that just, it's like, oh, you see January 1980 or that particular week. And it's just like, oh my God. And so what I'm trying to do is when gold and silver go into their blow off top, I'm trying to catch tranches of sales around that top, 20%, then 20% of the remainder, 20% of the remainder. By doing that, I will never run out. There's always a remainder. And if you can catch that, if anybody catches that top exactly, they were lucky. If they say they can right now, they're lying. But I do believe using numbers that I can get people in and out and capture most of this gigantic move that is ahead of us. So, and to get that, the only way that you can get it is by creating an account on goldsilver.com and buying something there. This InstaVault program, you're buying, we offer gold and silver in your IRA, gold and silver delivered to your door, or we can open a storage account for you at Brinks Security in several locations around the world. And it's guarded with guys with guns. These are the highest security vaults that you can have that have lasers and seismic detectors and everything else. But it's also got a bunch of guys with guns guarding it. So that's what I do with mine, makes me feel safe. More than half of my net worth is in precious metals. I want to thank you for watching, and thank you very much, Adam, for hosting this conference. We'll see you next time.